Residual value, also known as salvage value, is the estimated value of a fixed asset at the end of its lease term or useful life. Unguaranteed residual value, gross rental 800,000 times 5 equals to 4 million. Unguaranteed residual value equals to 200,000. To find the lease receivable or gross investment, add the 4 million and the 200,000, which is 4,200,000. Present value of gross rentals 3,032,640, and present value of unguaranteed residual value is equals to 124,180. To find the net investment, add the 3,032,640 to 124,180, which is 3,156,820. Lease receivable equals to 4,200,000, and total present value equals to 3,156,820. To find the unearned interest income, subtract 4,200,000 to 3,156,880 is equals to 1,043,180. Computation. Cost of machinery equals to 2 million, and present value of unguaranteed residual value equals to 124,180. To find the cost of goods sold, subtract 2 million to 124,180 equals to 1,876,820. Sales equals to present value of grow rentals, only excluding the present value of the unguaranteed residual value, which is 3,032,640. Cost of goods sold equals to 1,175,820, and initial direct cost equals to 100,000. To find the gross income, subtract 3,032,640 to the cost of goods sold and initial direct cost, which is 1,056,820. Note that the gross income must be the same under the guaranteed and unguaranteed residual value scenario. Guaranteed residual value. The guaranteed residual value is a promise made by the lease that the lessor can sell the leased asset at the end of the lease of guaranteed amount. Unguaranteed residual value refers to the value of a leased asset at the end of the agreement's terms that is not the responsibility of the lease. Unguaranteed residual values do not qualify as a financial obligation of the lease and do not factor into the calculation of the minimum lease payment. Return of asset to lessor. When the lease expires on December 31, 2024, the machinery will revert to lessor's company. Whether guaranteed or unguaranteed residual value, the entry of the books of the lessor will be the same. Sales type lease with purchase options. An entity is a dealer of equipment on January 1, 2020. An equipment is leased to another entity with the following provisions. Annual rental payable at the end of the year, 500,000. Lease terms, which is 4 years. Full life of equipment, 5 years. Cost of equipment, 1 million. Initial direct cost paid by the lessor, 100,000. Purchase options, 200,000. Implicit interest rate, 8%. Present value of an ordinary annuity of 1 at 8% for 4 periods, which is 3.312, and present value of 1 at 8% for 4 periods equals to 0.735. It is reasonably certain that the lease will exercise the purchase option on December 31, 2023. Gross rental 500,000 times to the lease term, which is 4 years, equals to 2 million. Purchase option equals to 200,000. To find the lease receivable, add the 2,200,000, which is 2,200,000. Present value of gross rentals 500,000 times 3.312 equals to 1,656,000, and present value of purchase option 200,000 times 0.735 equals to 147,000. To find the net investment, add the 1,656,000 to 147,000, which is 1,803,000. Gross investment. equals to 2,200,000 and net investment equals to 1,803,000. To find the unearned interest income, subtract 2,200,000 to 1,803,000 and equals to 297,000. Sales, which is equal to total present value, equals to 1,803,000 and cost of goods sold equals to 1,100,000. To find the gross income, subtract 1,803,000 to 1,100,000 and equals to 700,000. Cost of equipment 1 million and initial direct cost 100,000. To find the cost of goods sold, add the cost of equipment and initial direct cost, which is equals to 1,100,000.